Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value and entertainment out of these videos, I'll ask that you hit thumbs up and subscribe. Questions, comments, put those below. I'll start this one off with the Bank of Canada. They held rates firm last week at 1.75%. Basically coming out with a dovish tone saying, we're further behind our objective goal, which is to get to the neutral rate, but we're data dependent and, this and that. Whatever, they're always going to consistently miss their targets. But this is something that I've talked about in these videos for months on end, is that, rates have effectively tripled since they started hiking just over a year ago. And you're coming off a debt base, which is just, it's the highest it's ever been. Obviously, households are very susceptible to rising interest rates, and they're just never, they just can't get that far without something seriously breaking. And so I think 1.75 is probably done. The next move, in my estimation, could very well be a rate cut, not a rate hike, but that will likely come towards the end of 2019. But with that, there was, I think, a lot of misconception about housing markets, credit cycles, and the impact of monetary policy. There was an immediate assumption from some people that, if they cut rates, does that mean that home prices are instantly going to start rising again? And it's just not really how it works. First of all, there has to be not only a desire for banks to lend money, but there also has to be a willingness from the borrower to then go borrow that money. And so that's why we look in the United States, even though they cut interest rates, boom, 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 down to 0%, home prices continue to fall for another 4 years, ultimately bottoming in 2012. Because what happens is banks weren't lending and people had zero desire to borrow money. A lot of people had just been wiped out, devastated by a real estate crash. And there's just no desire to borrow money, right? What happened was you went through this painful deleveraging period where people wanted to pay down their debts. And so you can see in the US, the level of household debt, private debt, declined. Because this was a desire to pay down the debts, get out, restructure their household balance sheets. It wasn't a time to start borrowing more and more money. And so I think, unfortunately, Canada is in a very similar position where households never deleveraged in 2008. A large part of that is because of the federal policies that were implemented to do that. And so, unfortunately, as the Bank of Canada is well aware, is getting more and more economic growth out of the consumer is reaching a point where it's like pushing on a string. It's really no longer feasible. You're getting weaker and weaker growth. So you have to basically switch policies. And so that's why they've brought in the stress tests, etc., because they're going to try to reduce the exposure to the households and try to basically spread out the growth and try to find a new avenue to drive the economic machine. But with that, when you start to raise interest rates, it is going to create a deleveraging period for Canadian households, and so that will be something to watch. But we can already see that this process evolving through not only higher interest rates, but through macro-prudential policies such as the mortgage stress test, changes to CMHC, OSFI tightening on bank lending, HELOC issuance, etc. So what we can see is the change in household indebtedness. The rate of growth has decelerated for 18 consecutive months now. It's now growing at 3.24% on an annual basis, and that is the weakest pace of growth for household debt since the 1983 recession, which of course was quite a painful one. And so this is basically the effect of these policies. And again, this is all intended consequences because, you can only grow that household indebtedness so much before, like I said, it becomes essentially like pushing on a string. So what does this all mean, etc.? What we can see here is the correlation between the rate of change of mortgage credit growth and the rate of change in home prices. You can see in Canada, and similar in all real estate markets, that this is essentially like a macro. It's basically a macroeconomic law. Is that the pace and change in home prices has a strong correlation with the change in pace of mortgage credit. So as long as that growth is continuing to decelerate, your home price will generally follow suit. And this is not a mindset that is shared. It depends on your mindset and your worldview. Obviously, developers believe that the only way to change home prices is through increasing housing supply, and that any sort of rise in home prices, such as a 40% gain year over year in say Vancouver or Fraser Valley condos, is a direct result of a shortage of homes. There's never any discussion of maybe there's a credit boom that is potentially driving part of this growth, because it basically comes from a different train of thought. And then obviously when you're invested in the industry and it benefits you to say there's a shortage of homes, let's keep building, that's the viewpoint that you generally want to take. And so I can totally respect that. I just think it's a flawed way of understanding financial markets, in particular for housing. So I mean, that's something that came out. I think an interesting tidbit now to see this is we're seeing the slowdown in Greater Vancouver home sales falling to an 18-year low, Calgary 22-year low, Toronto 10-year low, and with that you can see a substantial deceleration in home prices. The regulators, as I've talked about, have not withdrawn this message that these are going to remain in place, and there's very little desire at this time, not to say that can change, to reduce or change those policies. So with the Bank of Canada holding firm at 1.75%, Stephen Poloz actually came out and said that he would be adamantly against and quite vocal on removing or any desire to change or amend the B20 mortgage stress test. He went on to basically say he's very much in favor and would continue to be against any macro-prudential policy changes that would basically encourage more household borrowing. But again, for the guy that's controlling the money supply, you can see that all these policymakers are working together, whether it's OSFI, CMHC, the Bank of Canada, and even the federal government are all working together to basically curb the growth of household indebtedness. They understand that it is a financial and systemic vulnerability, and so they're continuing to basically to put in these policy measures to basically curb borrowing, because you can't have long-term sustainable growth with an over-indebted consumer. As I've said, you can't keep deriving growth from that. Eventually, again, it just doesn't work. You're pushing on a string. So, long story short, I think it's very interesting to see them come out. Bank of Canada this week, a couple weeks ago, it was Evan Siddall of CMHC, going to Twitter and basically denouncing any sort of idea from developers or whatever that we should make some changes to the stress tests. These guys are not backing down. Again, that could change as this data starts to deteriorate. If the housing market gets substantially worse, maybe they will change that. But right now, at least at face value, I think what they're trying to do is very obvious to people that understand, and hopefully I've been able to explain that. The view that they're looking at the economy from. So that's pretty much it. And then, just to touch on that, we're starting to see this shift and movement away from the housing sector, where you've had this deceleration in household indebtedness, which is reducing the aggregate demand. That is basically reducing the sales volumes, which is effectively reducing the home prices. As the home prices decelerate, financing will continue to get more difficult. We're seeing that in the housing starts, where developers are starting to pull back. Some of that has to do with the construction financing that's getting much more difficult to obtain, because banks are becoming more and more cautious as we reach the tip of the cycle. Where you can see, nationally, the housing starts have declined for 5 of the last 6 months. In Vancouver, Greater Vancouver, the annual housing starts for 2018 finished the year at a 11% decline from 2017 and off the peak from 2016. So 2016 was basically your boom year for housing starts. Now 2016, generally when you start, particularly a condo development, that's usually 2 or 3 years down the way. So a lot of that supply, those completions are going to be ramping up and hitting the market here in 2019 and moving forward. Which will obviously add to the supply that we're getting, which has been increasing steadily. And so I think that's going to be interesting to watch because BC is real estate construction, that is our huge driver of GDP here. If you look at Stats Canada, again, some people might interpret this data slightly different, but if you actually just go in Stats Canada and look at real estate and construction as a percentage of GDP, in 2017, it was 26% of GDP. Now, again, some people will say, well, that shouldn't be in there, that shouldn't be there. And I've seen different revisions showing 22, 23%. But again, if you look at the official Stats Can and just click real estate and construction, GDP is 26% of the British Columbia economy. And then you have, 9.5% of the workforce is employed in the construction sector. So obviously any slowdown, as we're seeing now with housing starts slowing 11%, this is going to create a scenario where unfortunately there will be a rise in layoffs in that sector. They'll be slowing. Some tradespeople could go from full-time to part-time. And this has compounding effects, unfortunately, on consumer spending, GDP growth, etc. So there are serious compounding effects of a slowing housing market. As I said, and as many have talked about, is housing, a decline or slowdown in housing is much more significant than a decline or a slowdown in the stock market, because almost everybody is invested in the housing market to some extent. I believe the ownership rate in Canada is 69%. So you have 69% of people that own homes. But more specifically, it's the spin-off effects. Even if you don't own a home, but maybe you're in the construction sector, or maybe you're just a bartender, and obviously people are going out there spending money, getting more drinks as you feel wealthier, and it's the reverse effect of this wealth effect. And the wealth effect has actually been studied and shown to be the most predominant in the housing market, as opposed to any other financial asset. So that's something that I'm looking for into 2019. I think that the Bank of Canada is still backwards looking. They are still estimating a 0.1% boost in GDP from the housing sector in 2019. They have not revised that, I believe, in the last 4 or 5 months. I expect them to revise that lower. If they don't, it's certainly wrong. Will be wrong. The Bank of Canada still hasn't changed their GDP, their global growth outlook on the global economy. They're still predicting, I think, 3.7% global growth, which, China slowing down the fewest. The first time auto sales for the year declined in China in 20 years. The manufacturing index in parts of Europe, particularly in Germany, has been declining. So I think Europe is in a very interesting situation where they're starting to really slow down. Those are leading indicators. So I think this global growth phenomenon is slowing much more quickly than central banks, I think, understand. But that's just one opinion. I'm certainly not the expert, the be-all, end-all in this subject matter. This is just my thoughts. So open to debating those. If you have any questions, comments, thoughts on that, I'd love to hear it below. Otherwise, we'll see you next week.